I need some traction.
So we're kicking off this afternoon with Credit Karma. Ken Lin started Credit Karma with a small team of 3. Today, he has hundreds of employees, serving 50 million customers worldwide. And last reported, the company was worth $3.5 billion. That's billion with a B. So for this, I'd like to bring out Garrett DeVink, tech and telecom reporter for Bloomberg, and Ken Lin himself, CEO of Credit Karma.
Thank you. Cool. Thanks a lot. Hello, everybody. Good to see everyone again. It's like exactly the same as last year because it clearly went really well, and so I literally am having deja vu from being here last year. But thanks for coming out, and for those of you outside of town, welcome to Canada, welcome to Vancouver. And so, yeah, I mean, Ken, obviously CEO of Credit Karma, you just had an intro. This is probably one of the biggest, by private valuation companies we have here. $3.5 billion company, some really amazing investors, including Google. And so, our title is zero. They've changed it to billions. It used to be 0 to 1 billion. So I guess we can talk about the second 2.5 as well. But
all right.
Yeah, I mean, I think what we, Ken, maybe just to start it off, I'm sure most of us in the room know about your company, but for those of us who don't, maybe if you could sort of give us just a quick, a short paragraph breakdown of what you do and where you are in your journey right now.
Sure. So I mean, I don't know if breakneck speed. We've been around for 10 years, so I'm not sure exactly if that's breakneck. But from a business perspective, we started 10 years ago with this idea that credit finance, there has not been a company that's really focused on it from a consumer perspective. So our goal was to empower consumers by giving them access, by giving them education, and long-term, helping them find the very best products in the financial services space. And in the United States, we have we've acquired a user base of over 60 million people, and again, that's over 10 years. But there's certainly been some fun stories along the way.
Mm-hmm. So in terms of fun stories, I mean, maybe early on, I mean, we have a lot of people who are sort of at the early stage right now who are looking to grow really quickly. What's sort of a time where something was really challenging or confusing for you, and kind of tell us a story about that.
Yeah, I mean, I think the early war stories, I mean, so if you think about Credit Karma, we started in 2007, and we are a company that is focused in financial services. So if you don't, if you remember 2008, 2009 was not a particularly good time to be in financial services, right? I mean, I think the general census was that most banks were going to go out of business, and for us as a company that was a year and a half old that was looking to fundraise, you can only imagine how challenging that would be as an industry. So I mean, I think that was certainly one of those areas, and I think in the first 3 years we probably almost went out of business at least 3 times. So I think that tends to be more of the rule rather than the exception. My experience has been that a lot of times when you're a startup, when you're looking about your North Stars and the companies that you try to mirror, I think you hear about the outliers, and what you don't hear about are the war stories and how challenging it is and how many times you almost went out of business and how many contracts blew up. Mm-hmm. So I think for us, it was very much the case that we launched, we had good users, really great growth, but we also got to a point where we were running out of money and no one wanted to fund anything in the financial services space. So today, fintech is hot and in vogue, but that certainly wasn't the case 10 years ago. And regardless of the industry and the vertical that you're in today, I imagine some derivation of that exists today.
Yeah. So in terms of, you mentioned earlier when we were talking that you were trying to do TV marketing, which is something that as tech people, I think we have not really sure how to approach something that's not Facebook or AdWords. I mean, what exactly happened with that situation?
Yeah, so I mean, people a lot of times will ask about what are the inflection points at Credit Karma, and I have a couple, and I think one of the more interesting pieces is very much around defying your expectations and your own biases. So for me, prior to Credit Karma, I spent a lot of my time in digital advertising, so that was AdWords, that was display, and really built my experience on that front. So the backdrop of this story, and I don't tell it often, but I think it's pretty interesting and also indicative of how you can challenge ideas. So the backdrop was in 2011 or so. We'd been building our business for, at that point, 4 years. We'd figured out a lot of the unit economics, right? So to make sure that the operating cost of one user effectively was about the same as the revenue of one user. So it's very much at that point a function of scale. So how do we grow more users, which is really the growth hacking part of really any business. So we were doing everything that we knew from a sort of experience perspective. So the typical, search, the typical display, everything digital that you could think about. And I remember that at this point we probably had maybe $1 million in the bank. And I'd worked with some offline agencies in the past, so the traditional media players. And I remember we went to them and we said, hey, we've got a couple bucks, and we really want to try things like television to really understand, is this a viable channel? We've got about $1 million. What do you recommend? And what do you think will happen? And I remember very succinctly, they said, really, you're going to need to spend about $400,000, $500,000 in television to get a read. And you're going to need $100,000 creative. You're going to need $300,000-$400,000 worth of media. And if you're successful, you'll get like a signal of whether that will work. And as a CEO of a company that had about $1 million, and somebody suggesting that we spend half of it for testing, didn't seem like a particularly good idea. So what we did was, this was also at the same time of, I think, SpotRunner and Google television auction. So, I think as any startup would do, we went and we shot a commercial on my DSLR. We had our internal team sort of hand act the commercial itself, and we also had our team go into a sound studio and record the voiceovers. And I think all in, our commercial cost, I'd say maybe $150 between the studio time, the calendar, and the props.
How good was it, though? I mean, was this?
It's actually pretty good. I should have brought it. Yeah, it's actually called Calendar. I think it might be on YouTube.
We'll tweet it out or something from the
I think we might have a link
Traction account. But yeah.
So we put it together for basically $150, $200, and I actually forgot about it. And I remember that we sort of just. I was running on other things, but I remember one day we got an email. We get emails every time what we call good hours. We get like more than 100 users. The whole team would get an email. We got more than 100 users at that hour. And I remember I got one of those emails on a random Tuesday, and I didn't think anything of it because sometimes you get press. I remember the next day I got another one of those emails, and at that point I called our head of marketing and said, what's going on with these emails? They're coming at 11:05, because they come 5 minutes after the hour. It's 2 days in a row. It's really weird. And I remember our CMO now, said, I think it's television. And I'm like, well, that's surprising. And the big question then is like, well, how much did you spend? And I think he said something like $150, right? So, it ended up being a really profitable and great way for acquire users, for us to build our brand. It doesn't work like that anymore because I think it was like a lot of the early adopters. The point here was I personally didn't think that television would work. We were going to agencies who were telling us that we were going to need to spend $500,000 to measure the impact of that particular campaign. And we were able to really drive and I think in many ways create a brand through that medium for effectively $300, right? So, the professionals didn't think it would work. I think in many ways I didn't think it would work. Mm-hmm. But we went through anyways because, I think a lot of times being a CEO means, challenging your own biases and challenging your own ideas and always just being open-minded. And I think that's an important part of entrepreneurship. Yeah. And I don't think I'd be up here on stage talking about the breakneck speed if we didn't try those things.
Of course. I just have this image still of you as like used car salesman, like TV ad, like 100, but I'm sure it's great. I really want to see that. But, so you've been very successful at grabbing users who are, retail, financial kind of services users, the everyday person who needs a credit check, who needs these other services you provide. I mean, how do you think about kind of the mind of the retail financial consumer and where are they at right now, in terms of maybe trusting new entrant brands like yourselves versus they were when you started?
Yeah, so I think this is another important aspect for a lot of startups. So if you think about the landscape of when Credit Karma started, in 2007, there were a lot of, at least in the United States, there are a lot of companies competing for the mind share of consumers for credit monitoring. The idea that credit scores were important, credit monitoring, protecting your identity, was an industry that was probably 5 years old. There was a lot of marketing dollars against it. They were all positioned as free credit scores. And the reality is none of them were, right? So in virtually every single case prior to Credit Karma, they would call them free credit scores, but you'd have to enroll in a $20, $30 a month product. So by the time that we launched, everyone in the United States knew that was a prevalent model. So while everyone called it a free credit score, everyone knew that there was a catch. So when we started, we had to go against the mindset of the traditional convention and wisdom that, well, there is no free lunch in credit scores and credit data. So that was the sentiment, and we spent a lot of time in the early days really trying to break away from the rest of the pack and elevating our brand. And we used press quite a bit because we were we were the only free company at that point. I think that for us, building trust has always been a part of our business, a part of our brand. I think a large part of our success. And for us, you have to make a conscious decision at the beginning whether you're going to be a company that is going to value the trust of your users, or you're one that's going to potentially betray them or focus on the monetization. So for us, we had the benefit of having no monetization, so we didn't have to worry about selling out any of our users in the beginning because we didn't have any revenue, right? Because nobody wanted to advertise on our site because every bank was going out of business. So we put our head down and we focused on building great products, building a brand, building trust with our users, and I think in many ways we're seeing the dividends of that today. So I think if you take a look at the title of this talk, I think that's one of the things that people really have to think about in the beginning is what's the brand you're going to build and how true will you stay to it? Because I think at a lot of points in times when Credit Karma was growing, we could have done a lot of things, right? We could have sent a lot of emails, we could have sold data, and those could have been the things that we did to raise the money or not gone out of business. But we said, hey, what are our principles? What are the things that we really value? And ultimately, we decided not to do any of those things, even at the risk of going out of business
because
to build a brand.
Your model is, you essentially, you bring in customers with all these great free products, and then you refer them on to, people who are selling financial products in the market, right? And so, obviously, there's a bit of you want to be careful not to push the funnel too much, right? And not ask people for too much.
That's right. Well, so there's that, but I think what a lot of people don't know or what they assume that we do is that we sell consumer information. So we could have sold consumer information, but we thought that was a business model that we didn't like. So we have a lot of users, we have a lot of financial information on those users, and I think the expectation was, well, Credit Karma is going to sell this. We hated that idea, but when we were on the verge multiple times, we could have sold it, but we decided not to, right? Because we didn't think that was good for consumers. We said, well, we'd rather go out of business than actually sell out our user base. And I think going back to what people in this room might be facing is, kind of figure out what your North Star is, what are your values and your belief, and stick to them. And for us, those things really paid out in the long term. But it's easy to lose your conviction when you're about to go out of business.
You stick with your conviction, and then if at a point where you're like, okay, I got to become, just like all the other companies, that might not even be worth it. Maybe you should be doing something else.
Well, I think that's right. When we started, it was a sea of Me Too's, right? And we said, what are the things that are going to make us differentiated than every other company that is charging consumers for credit scores? Well, it's going to be, that didn't believe in privacy, that was, sort of not upfront about their business model. So we said, let's make a promise to consumers to differentiate ourselves, and then let's stick to those things long term.
Right, and it's paid off. I want to ask you about Canada, though, because we're here, and you just, your company launched in November of last year, right? So it's only been about 6 months since you've been in the market. How's it going?
Yeah, so in November of this year, so we've been in the United States for the last 10 years, but in November of 2016, we launched Credit Karma in Canada, with the exception of Quebec. And we've been able, this is the first time we've talked about it, but we've been able to acquire about 600,000 users in Canada, which I think makes us the largest credit monitoring site in Canada. So I think it's sort of a testament to building brand, building trust, and kind of, again, sticking to your guns.
Is Borrowell here? But I don't know, Andrew. But that 600,000 in Canada is I would say objectively relatively impressive, just because we have an interesting fintech market here where people love the banks. Whenever you ask the top Canadian brands, for some reason, even though we hate them, it's always TD, BMO, RBC, Scotia, and it's rare to see something that is really shaking things up. Although we have seen more and more in the last couple of years. What have sort of been your learnings about the Canadian market and how it's different than the U.S. market, or in the short time that you've been here?
Well, I think the good news is a lot of our marketing, our brand has kind of bled over, right? So, I think people have known about the Credit Karma idea, so that's certainly helped us quite a bit. I think probably I think the learning for us has always been that the Canadians are actually much nicer. We don't have nearly as many customer support issues from angry users. Maybe we're a little bit more entitled.
Do you have like data on that?
States.
You like finally have the data on how we're actually nicer
Well, no,
to confirm the stereotype.
Well, even one proof point was, I'll do things on Reddit and just because I love talking to our user base. And in Canada, there weren't many cynics, right? In the United States, I always get the very cynical, like, well, how are you selling my data? And, if the product's free, then you're the product type of approach,
right.
Which I think can very much be the case. But I remember doing the Reddit AMA with Canada Personal Finance, and people were so polite and thankful. So that wasn't your point, but that was one of my
so
observations.
embarrassing. Yeah, no. Well, I mean, yeah, and obviously it's early days in the market, so we'll kind of, I'm sure you'll be learning more as you go. But yeah, I mean, we've got a few minutes left here, and so $3.5 billion valuation. We had relatively successful IPO from Snap a couple months ago. People are talking about IPOs again like they didn't last year. I mean, what's going on with that? What's the next step for Credit Karma?
Well, I think a lot of people think of IPOs as really the end goal, and I don't know. As I've been thinking about it and trying to be a student of the financial services sector, you realize it's really the beginning of another journey, right? And for Credit Karma, we've been really fortunate. I mean, I think a lot of our valuation, but also a lot of the way that we've built the business has been on the fundamentals. So we've been really lucky in that we have really patient investors. And for us, building a company in the public world is a little bit different and can potentially be more challenging in the private world. So I think we want to just make sure that we get it right.
Yeah.
I mean, I think you see a lot of companies flame out because I think their primary goal is to go public, and you realize that, well, going public doesn't really mean anything, right? You trade 5-10% of your liquidity in the sort of the IPO, and then you have to figure out how the rest of the story plays out. And what it really turns into is a 3 or 4 year process.
Are you getting a lot of pressure though nowadays, more so than? I mean, I'm sure you've got bankers calling you up and saying.
Yeah, so I mean, I think for the people in this room, be really thoughtful of who you want your investors to be. Because what I see is a lot of the companies that are rushing to go public tend to be those companies who have investors who have a particularly narrow time frame. So as a result, they have a 5 or 7 year redemption period. They aren't able to create liquidity, and as a result, they tend to have to rush rush out the door to go public to return the capital and the investments that that the investors have made over the years. And I think we were lucky. We were slightly thoughtful, but we were probably much more lucky in that none of those investors wanted to invest in us in the early days. So we avoided a lot of that. So as a result, we actually control our own destiny.
Did you have like sort of parameters even in the early days? Because you have when you look at your cap table, I mean, it's pretty diverse. You've got hedge funds, you've got Google Ventures, which is sort of a pseudo strategic, and then you have traditional VCs as well. So, I mean, did you say, these are the kind of investors we're looking for, or what was your methodology when you made those decisions?
Yeah, candidly, the first investor, we had almost no choice, right?
Okay.
It was basically the only term sheet that we could get, so we basically took those terms. But probably around our Series B, we became a lot more thoughtful. And we said, well, what type of investors do you want? And I would say that, just roughly saying there's probably like 2 or 3 categories, right? I think there are the great brand names, right? The tier 1 investors. I think they're great from a networking perspective, but they tend not to be operators. They tend to have a brand, and they tend to sort of focus on their brand more than helping out the companies. And I think there's another class of investors that are very much operators. And for me, they were the ones that ultimately added the most amount of value. So, when you talk about Google Capital, I think they're fantastic from the perspective that they can get you in front of the Google security team. They can get you in front of the people who are doing web spam and give you a perspective of, here's how you can optimize particular programs. So I think you have to be pretty thoughtful about who your investor base, is going to be, right? All dollars are green. They're all kind of fungible in that way. And I think that a lot of entrepreneurs will think too much about the valuation, and they'll optimize for the valuation. In my mind, that's the wrong outcome. I think in multiple portions of our rounds, we had higher valuations from other companies, at least in the later stages. Yeah. And we always deferred to the investors that we thought we were going to add the most amount of value rather than the ones that gave us the highest sort of valuation in terms.
And were you looking for people who had particular fintech experience, or were you nervous that you didn't want a bunch of people who knew fintech and were going to tell you what to do in the room with you?
No, I mean if you look at QED, was our Series A. They were a group from sort of the founding team of Capital One. Ribbit Capital for us was basically all fintech investments. So we wanted that, and I think that as a CEO, it's important to be open-minded, and I always love sort of perspective and lots of ideas.
Yeah.
I think the balance is having a lot of ideas that you can grab from your board and your investors, but then also having the willpower, having the ability, the rapport to say no, and having the respect and the relationship where no one feels offended if you say no.
Right. Okay. Cool. Okay. Well, we got 15, 14, 13 seconds left, so we'll let you guys move on to the next one, but to let everyone. But yeah, thanks again, Ken, for coming all the way up here to Vancouver.
My pleasure. Thank you.
Thanks.
I need some traction. You need some traction. Let's get some traction.